Good afternoon, everyone. It's Monday, the 23rd of September. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. The data coming out of China continues to be disappointing and a little bit concerning. So the recovery there seems to be continuing to be delayed. But on the other hand, the Fed has finally started their easing cycle with a 50 basis point cut last week, which was a little bit on the higher end of expectations. So what will drive markets this week? We look at finding value as rates come down in these markets. We had a very busy weekend in Singapore with Lando Norris winning the Singapore GP. Some of us who are Red Bull fans are a little bit disappointed, but just like the fireworks after the race, Singapore's exports are also really on fire. We have Brian Lee, our economist, who's going to be taking us through the numbers. Then we turn to Samuel Yin, who's going to be talking to us about Malaysian aviation and why he thinks that the winds there are blowing just right for this sector. And then we answer the question on whether a stock can be a value as well as a growth stock at the same time. We've got Jarek who says he's found one. So stay tuned till the end of the show to find out what that is. And also we've got technicals as well. But before I begin the show, just want to point out that we've got a Telegram channel that is out there. You can join this channel for free with this QR code, and you'll get a lot of our latest updates in terms of our latest ideas, macro, as well as special offers, all in one place. So please do join this Telegram channel if you haven't done so already. Now, with that, let's turn to Brian. Now, Brian, Singapore's non-oil domestic exports or NODX expanded for the second straight month in August. What's driving this? Any key highlights that you can share with us?
Sure, Dylan. Yeah, so non-oil domestic exports expanded for the second consecutive month in August, climbing by 10.7% year-on-year. Although this was slower than its July pace of 15.7%, I think we got to remember that the July pace is exceptional. There are some very bright spots in the September data. So if you look at electronics exports, electronics NODX growth more than doubled to 35% year-on-year from 17% in July, and 35% is the strongest performance since June of 2010. Growth was driven by semiconductors, which surged by 52% year-on-year, and also disk media products and PCs. Non-electronics growth, on the other hand, slowed to 3.7% from 15.5% in July, and this was mainly due to a renewed decline in pharmaceuticals and also slower growth in petrochemicals. So yeah, I mean, if you, let's say, take a broader view, I think this NODX print is also consistent with what we have been seeing in the manufacturing sector. So if you look at the PMI for August, both the headline manufacturing PMI as well as the electronics PMI actually managed to pick up quite strongly in August. The electronics PMI surged to the highest level in 6 years.
Got it. Now, I just want to, focus a little bit on China and North Asia in general, given the slowdown that we're experiencing there. How has NODX out of Singapore fared into this region?
Yeah, so we have the numbers for China and for Hong Kong. If you look at NODX to China, actually it was performing pretty well in August. It grew by 18.8% year-on-year in August. I think you need to strip out the effects of non-monetary gold because it tends to be rather volatile, rather lumpy as well. And excluding gold, exports to China, non-oil domestic exports to China grew by a more modest 14% year-on-year as compared to 21% in July. So even though this is still not too bad of a print, but it's nonetheless the slowest in 9 months. Basically, growth is being driven by specialized machinery, which more than doubled, and also pharmaceuticals. Now, if you look at Hong Kong, which is known as a conduit for China, Hong Kong growth in NODX to Hong Kong actually is pretty strong at 71% year on year as compared to a contraction of 3% in July. And the growth is being fueled by semiconductors, which more than doubled 160%, and also these media products, which as well more than doubled. Yeah.
Got it. So this could actually be a sign that supply chains are moving more towards Southeast Asia for China as well. Now,
Yeah.
what are expectations for NODX going into the second half and also for GDP?
I think we can agree with the Enterprise Singapore's full year forecast of 4 to 5% for full year NODX growth. This means that we are basically going to see a sustained rebound in exports in the months ahead. We think that electronics demand will strengthen further on the back of semiconductors. We think that semiconductor demand is broadening beyond AI chips, which are more of the advanced node chips that Singapore doesn't produce, which also explains why Singapore's recovery has been lagging Korea and Taiwan. But I think in the months ahead, we think that's set to change with fresh consumer electronics product cycles and also new AI applications boosting orders for memory, storage, and networking chips. So as for GDP growth, our full year forecast stands at the upper bound of MTI's forecast range, which is 3% in 2024. We think with the rebound in exports and manufacturing, on top of that, with the declining interest rates expected to support sectors such as financials and real estate, we are thinking that GDP growth for the third quarter is on track to come in above 3%. Yeah.
Got it. Got it. And just finally, do you think the MAS will loosen in October or will they stay pat?
I think amid a backdrop of a strengthening economy, there's actually no need to loosen policy so urgently. We're expecting them to stand pat in October. And I think other than the strengthening economy, core inflation is still above what MAS wants to see. Core inflation was at 2.5% in July as compared to the pre-pandemic historical average of less than 2%. So we are only expecting MAS to ease the slope in the near slope in January 2025, when both core and headline inflation will be comfortably below 2%.
Got it. Thanks, Brian. That was Brian, Singapore economist, talking about NODX. Now let's fly over to Samuel. He's joining us from Malaysia, and he's pointing out that there's some very strong tailwinds for the Malaysian aviation sector. Samuel, can you explain what you mean by this?
Yeah, sure. Hi, Dylan. So the ringgit and oil prices have been trending nicely for the aviation sector. I mean, the ringgit, as we all know, has had a terrible 1-2 years, but recently it has recovered to about 4.25 against the dollar. And also jet fuel prices have plunged to below $90 a barrel. Now, this is very positive for airlines because about 80% of their OPEX are denominated in dollars, and jet fuel accounts for about half of the OPEX. We have quantified that every 5% recovery in average ringgit-dollar exchange rate will accrete about 100 million ringgit to capital A and about 25 million to AirAsiaX, while every $1 per barrel reduction in average jet fuel price will accrete about 50 million ringgit to capital A and about 13 million ringgit to AirAsiaX.
Got it, got it. But now, what about Malaysia Airlines? I mean, they've been having a bit of a tough time. They've reduced capacity. How will that impact the rest of the aviation sector, especially Capital A and AirAsiaX?
Yeah, sure. So, in the past, lower OPEX through the stronger ringgit and lower jet fuel prices was, not always very meaningful for the airlines because they often passed on the cost savings to the passengers via lower fares, for fear of losing market share. That said, we believe that, the airlines will not cut fares, especially after Mars on Malaysia Airlines temporarily reduced capacity by 18% until year end. Now, my feeling is that this capacity reduction will last beyond the year end because, as we all may have heard, the Boeing workers are actually on strike. So that's another woe for that company. And Malaysian Airlines has been looking to Boeing to renew their narrow body fleet, but that doesn't look like it's happening anytime soon. So what happens is that the airlines will probably raise fares on reduced industry supply. Now, how do we know this? We saw this exact same thing happen in 2015 and 2016 following the MH370 and MH70 tragedies, where Malaysia Airlines cut capacity tremendously. So this is not new. It has happened before, and we do foresee that this will happen again, especially in the second half of this year. So in terms of the sensitivity analysis, every 1 ringgit increase in average fares will add about 30 million to capital A and about 3 million to AsiaX.
Got it, got it. So there's potential upside on the top line as well as on the cost side as well. Now,
Yes.
you know, something that was very interesting to me in your note was your assumptions, and you were saying that, you know, your assumptions are quite, you know, conservative right now, and then if you actually kind of move those assumptions from the conservative level to where things are currently, you know, that's going to have a big impact. Can you explain to us what you're seeing there?
Yeah, sure. So my estimates are based on average ringgit dollar exchange rate of 440 to 450 and jet fuel price averaging about $100 a barrel. Now, what we did is that if we exclude any upside to fares and rebase our earnings estimates to account for the ringgit appreciating to 435. It's at 420 actually right now, but let's say we rebase it to 435, and average jet fuel price we rebase it to $90 a barrel. It's about 100. Basically, our capital A and AsiaX earnings will double. So that's how powerful these tailwinds are. And that will mean capital A target price going up from 1 ringgit to 138, and for AX going up from 271 to 606. So that gives you an idea as to, you know, just how powerful these tailwinds are again.
Got it. So some big upsides to capital A and AirAsiaX. So Samuel, just before you leave us, can you give us a little bit of a flavor on, you know, the two stocks that you're recommending, and is there a relative preference of one over the other?
Right. So you may have heard that both of them are supposed to merge quite soon. At least for capital A, they're disposing the airlines to AsiaX. But the way I see it is this. If you look at the merger mechanics for an AirAsiaX shareholder, for every 1 share he has, he or she gets 1 full share in the merged entity and half a free warrant. Whereas for capital A shareholders, they only get half a share of the merged entity. Now they do get the non-aviation assets, but that will take quite a while to unlock. It'll take quite a while to unlock the value. So there's still work to be done. Whereas the upside is more. The upside it's higher and it's more immediate with AsiaX. So between the two, I would prefer AsiaX.
Got it. So Samuel's full note is in today's newsletter. So do have a look at that. Very interesting note. Potential for very strong upsides from the Malaysian aviation sector. Thanks, Samuel, for joining us.
No worries.
Now, let's come back to Singapore and let's look at SREITs again. I know we've been featuring Krishna and SREITs quite a bit in the past few weeks, but given where the rate cycle is, I think it's very important to stay on top of where this sector is going. Now, Krishna's put out a really interesting note where, and so let's go through that. Now, the Fed cut interest rates finally, and at the higher end of expectations that I said earlier. The sector obviously has run ahead of this. Krishna, you're saying that this could actually be a bull trap. What do you mean by this?
Yeah, thank you again for having me. I can't really get rid of this sector, but So you see the index has run about 15% over the last 3 months, and that came on back of a job number which started in the weak job number which started in July, and since then Fed kind of confirmed that it's time for the rate cuts, and then delivered on as I said on a higher side of expectation. So as we see that this sector, as I told, was 15% up on back of the lower discount rates. So now we need to see how the data kind of comes up on the growth and inflation, and whether Fed is able to follow through on the recalibrated dot plots wherein the rate cuts have been front loaded. So if that happens, then definitely the sector is favorably poised. But we need to see how the growth and inflation number comes in, because if they turn the other way, then we are starting from a relatively higher side of the valuation, and possibly the positioning is also quite heavy. So that's why I think I kind of asked the question to myself that whether we are ready for the next leg up, or we kind of consolidate, see how the data turns up, and then proceed accordingly.
Got it. So there should be some trading around these stocks right now. But now let's assume that if rates continue to fall and the interest rate trajectory remains accommodative, then how should we think about the overall sector? If we take a more medium-term view.
Yeah. So if it pans out that the rate trajectory kind of follows the Fed's dot plot, then I think that should be favorable for the sector, and we do think that there will be more broadening of the sector rally and away from the large caps index names to the more mid cap names, and again from more Singapore concentrated names to the more geographically diversified names. And so that I think we have in our top picks, we have proceeded along that. But as I said, the key element to look out for is how the growth and inflation pans out. And also we are having the upcoming MAS policy review, because the way the Singapore policy framework works, it will likely to have a impact on the yield curve as to how the MAS policy changes. So we need to keep a watch out for that. But by and large, if the interest rate trajectory remains on the downside, or that is the Fed continues to cut rates, that should be positive for the sector.
Got it. So, I mean, for the audience, do dial in very regularly to Monday Market Picks, because we will be bringing you the latest in terms of what the Fed is doing, as well as how that impacts the REIT sector. Now, Krishna, before I let you go, what has changed in terms of your top picks and preferences, and why?
Yeah, so basically what I have done is taken out Capital and Ascendus, and that's primarily because it's yielding about 5%. The stock has done extremely well, both in the near term and through the whole rate hike cycle. So we are taking that out as a limited upside to our target price. And we are substituting that with CDL Hospitality Trust, again on a higher side on the yield, about 6%. A lot more geographically diversified, and hopefully it would benefit from the F1 and then the conferences that's going through the third quarter. It has about 65% of the revenue exposure to Singapore, and that's the main thing that we have done in terms of our in terms of the top picks. By and large, as I said before, moving slightly away from the large cap names to the mid cap names, and again from the low yielding names to the high yielding names, and also from a more Singapore concentrated focus to a slightly more geographically diversified one. So that's primarily the shift that has happened on our topics.
Got it. Thanks, Krishna. Thanks for joining us. Now, Jarek is traveling this week, but he writes that Marco Polo Marine is deeply undervalued. He's putting money where his mouth is, and this is a high conviction opportunity plus stock, which has nearly 48% upside on his target price. Now, when you look at the recent Atlantic navigation vessel sales as a benchmark, Marco Polo Marine's existing vessels have a value of around 195 million Sing dollars, which is actually close to the company's market cap. Plus, their fleet is a lot younger, at about 7 years of age versus Atlantic's. Now, when you take the upcoming vessels, which includes crew transfer vehicles, which are called CTVs, as well as CSOVs, they are worth another 105 million Sing dollars. So their existing fleet plus the upcoming fleet are worth more than the market cap of this company. We also see that the CTVs are going to be a new growth engine for this company, especially from demand coming from wind farms as well as from oil and gas. We expect them to supply 2 CTVs by the end of this year, but this will go up to about 10 to 15 units within the next 4 to 5 years. So a huge jump there. And we're also expecting a lot more shipbuilding orders to come in FY25. So overall earnings growth of around 24% next year, but valuations are very cheap. The stock's trading at about 7.4 times FY24 PE, when global players are around 15 times and regional players are around 25 times. So huge discount, strong growth, and overall vessels and assets are already higher than market cap. So significant upside from this stock. So this could actually be one of those stocks which are growth plus value. So do have a look at that and look at Jarek's note in today's newsletter. Now let's hop over to technicals. Our chart guy has a trading buy on Sing Post. The stock's broken out of its double bottom pattern with strong volume last Friday. So do look at that. He has a trading sell on Delphi Limited. The stock has been consolidating on its triangle pattern at the moment. So do have a look out for that as well. In terms of upcoming announcements, we are looking at inflation rate coming out on the 25th for Singapore and industrial production out on the 26th. Bank loan numbers coming out on the 30th of this month, as well as the PPI numbers also out on the 30th of the month. In terms of events, do remember to sign up for the StarHub exclusive investor night on the 25th of September. And some of us are traveling for Invest Malaysia in Johor for the special Johor Economic Zone on the 26th of this month. We'll bring you back whatever that has been discussed in that event. Thank you for joining us this week. Thank you as always for your support, and have a profitable trading week.